Good evening.
Good evening, sir.
Good evening, sir.
Good evening, everyone. How are you all?
Good, sir.
Awesome, sir.
Good, great. Awesome, huh? Super. Yes, videos on quickly. Sana, are you there in the class? Sana, Praveen, Sharon, Mahima, Shant, everybody, quick. Let's start. Yes, so you've got enough time, Allah, to plan your things. Correct, no? No? Huh? ಸರ್ ಎಷ್ಟೇ ಕೊಡ್ಲಿ ಸರ್ ನಮ್ಮ ಟೈಮ್ ಸಾಲಲ್ಲ ಅಲ್ವೇನೆ ಕರೆಕ್ಟ್ ನೋ ಹಾ ಹಿರಣ್ಮಯಿ ಹೌ ಮಚ್ ಎವರ್ ಟೈಮ್ ದೇ ಗಿವ್ ಇಟ್ ಇಸ್ ನಾಟ್ ಇನಫ್ ಯು ಹ್ಯಾವ್ ಎಕ್ಸ್ಟ್ರಾ ಟೈಮ್ ಇನ್ ಹ್ಯಾಂಡ್ ನೌ ಆರ್ ನಾಟ್ yes
We have enough.
Yes, sir.
you have enough time don't think like that but okay think like there is no time ah ಸರಿ ಏನ್ ಸರ್ ಇವ್ರು ಹೆಂಗ್ ಕೇಳಿದ್ರು ಉಲ್ಟಾ ಹೇಳ್ತಾರೆ ಇವರು ಬಟ್ ಸೀರಿಯಸ್ಲಿ ವಾಟ್ ಹ್ಯಾಪನ್ ಸಮ್ಟೈಮ್ಸ್ ಇಟ್ಸ್ ಬೆಟರ್ ನಾಟ್ ಟು ಹ್ಯಾವ್ ಎಕ್ಸ್ಟ್ರಾ ಟೈಮ್ ವೈ ಆರಾಮಾಗಿರ್ತೀರಾ ಡೋಂಟ್ ಡೂ ದಟ್ ರೈಟ್ ಎವ್ರಿ ಸೆಕೆಂಡ್ ಇಸ್ ಇಂಪಾರ್ಟೆಂಟ್ ಯು ಅಸ್ಯೂಮ್ ದಟ್ your examination is next day only like how it is normally used to be with a 1 day gap with the same level of rigor you need to prepare okay everybody don't take it lightly every second is important every minute is important yes all right so with that let us start with the first financial management right so let me quickly share 1 second. Yes. Yes, so maintain the same josh till the last minute of this exam. Okay, it's a very easy, common sense subject. Revise all the formula. This I tell time and again, right? We have been telling. So now what you do is till your examination day, every day go through the formulas at least. Clear, everybody? You have the formula list with you, so go through all the formulas. Okay. First impression is the best impression for both FM as well as SM. So I'll be covering both today, right? FM as well as FM. Ensure that you're starting with the easy best known question, right? So impressing the valuer at the first instance is most important, right? So maintain a good pace, right? And consistent pace for both subjects. Plan out well, right? It should not happen that you're only writing FM and then you don't have any time for SM. Hatara ಮಾಡಬೇಡಿ. Both subjects give equal importance. Clear, all of you? In your preparation time also, now one of the best things that has happened is what you can take positive out of this is because the extended time SM na ignore ಮಾಡಬೇಡಿ. What you have been doing always, right? Ignoring SM, don't do that. Give its due, it will give you the return. Give what is the respect that the subject requires, will definitely give you the return. What I've seen of late is people are only doing FM. No, both are equal, baba. Artha aita. 50 and 15 FM, you get very less in SM, there's no point. Rather you can score 80% of both the subjects. Artha aita, all of you? Yes. So again, revise the formulas every day when it comes to FM. Okay, stepwise approach in FM is appreciated by the valuer. All right, working modes obviously are important, and but final answer is important in costing as well as FM. Final answer is also equally important. Now coming to FM, very simple. I've told this always, right? Leverages sweet chapter, right? Sweet chapter, very small chapter, high scoring chapter, definite question, right? Every other examination question from leverages comes. Next, dividend decisions. Again, a very small chapter, sweet chapter, compulsory question in almost any given paper. Dividend. So dividend decisions and leverages today only finish it off. Don't keep it for tomorrow. Right? Easy. You can finish it. I mean, whatever your preparation is, I don't know how it has been planned and told for you guys when you're supposed to read audit and when FM, but whenever you're reading FM and SM, ensure that the first thing that you complete is leverage and dividend decisions. Is it clear, all of you? Yes. So capital structure theories only, do not spend a lot of time on the theories, right? So concept is important, go through the concept aste, but focus more on the examination and the problems of the capital structure theories. Understood, all of you? Rather than doing a lot of these NOI approach, NI and all, it is just half an hour job for you to revise what all the capital structure theories are. Clear? Anyway, I'll be going through all of them when I come to the subject analysis. All right. right? So repetitive theory, again, do not ignore theory in FM. Repetitive theory is there. Kindly go through that, and then easy problem area. So ratios, working capital, dividend decisions, leverages, cost of capital. All this is easy. Clear, all of you? All right. Do's and don'ts. In the last page, rough sheet, 5 to 10 minutes. Write points for each question to be attempted. Working notes is important. Stepwise approach is important. Final answer is important. For theory, maintain study material, language as much as possible, especially in SM also. Okay. Relaxing before 3 hours is a crime. You cannot do that. Like I said, it's not about being slow in the fast or fast in the end. No, it's not about being very fast in the start. No, consistent pace from the start till the end. That is what is important. Unnecessary tension, ignoring theory, anticipation. Oh, this subject will be easy. Right after audit, oh, audit was very tough, so FM will be easy. No, audit was very easy, therefore FM will be tough. No anticipation required. Okay, write the question number including sub questions are very important. I'll show you the answer keys tomorrow. Later on, you're supposed to write the question number at the beginning, highlighted, write very clear question number and sub questions. It will be question 2a, question 1b, like that clearly it should be mentioned. You can write the questions in any order, but whichever question you pick, other sub question is suggested to be in the same order, like 2a, 2b, 2c. Clear, all of you? You can write question 5 first, question 6 later, but ensure that it is in the same order. Attempt any extra question compulsorily. If out of syllabus, then you can get marks. The only limit to our realization of tomorrow will be our doubts of today. Yes, so have faith, have confidence. For success, attitude is equally as important as ability, right? Don't stop when you're tired, stop when you're done. Okay, I know that some of you are tired. Ayyo, sir, it got extended. Doesn't matter. We are not done yet. Correct? Let's stop only when it's done. All right. Quickly, let us revise the subject. Financial management, efficient procurement of funds, and effective utilization of funds. Yes, three important decisions of a finance manager: financing decision, investing decision, and dividend decisions. Clear, all of you? The important objectives, right? So, always FM focuses on the long term objective of wealth maximization, whereas profit maximization is the short term objective. All right, so types of financing: long term, medium term, and short term finances. Really, there are all the list of finance which is given, which you can go through, which you have gone through in the class also multiple times. Clear? Then American depository receipts, right? It is a depository receipts issued by a company in the USA. Yeah. Global depository receipts, it is denominated in US dollars, which represents a non-US companies, right? Publicly traded local currency equity shares. Then debt securitization, process wherein illiquid assets are pulled into marketable securities. That is called marketable. To make it liquid, that's the most important thing. So illiquid securities, you're making it liquid, right? That is called debt securitization. Deep discount bonds and zero coupon bonds, right? That is, both of them are issued at a deep discount, right? There is no interest for the same. So issued at a, say, 1,000 rupees bond issued at rupees 100, right? Or issued at rupees 10, a deep discount bond. Maturity would be normally at the face value. Venture capital financing, right, refers to financing of a new high risky venture, right? That is when venture capital financing will come into picture. So when methods of venture capital financing, you have equity financing, conditional loan, income note, and participating debenture. Bridge finance. So this is for bridging the gap between a long-term finance, right, which may take some time for processing. So in between, a bridge finance is given, right? So this is normally short-term in nature. Types of bonds, you have callable and puttable bonds. Callable bonds, which gives the issuer the right to redeem the bonds prematured, right? So I can call for my bonds. Puttable bonds, investor has the option to sell. So this is the option to. Callable bonds, the investor, or sorry, the issuer can call for the bonds premature. That is called callable bonds. Puttable bonds, investor has the right to sell before maturity. Right to buy and right to sell. Free foreign currency convertible bonds, very low interest rate. It has to be redeemed on the date of maturity. Plain vanilla bonds is your normal bonds. Clear, all of you? The normal bonds that is issued, that is my plain vanilla bonds. Convertible floating rate notes, right? So why is it convertible? Obviously, it can be converted, right, into equity at a later point of time. That's why it's called convertible floating rate notes. Drop log bond, here the rates will be, will have a stop. So it cannot go below it. That's why it's called drop log bond, right? Then variable rate demand obligation, a normal floating rate note with a nominal maturity. Yield curve note. It is a structured debt security. Yield increases when the prevailing interest rate declines and vice versa. Okay. Yankee bond. So denomination in dollar issued in the USA. Euro bond, right? So bond uses a certain currency but operates outside that jurisdiction. Underline that, outside the jurisdiction. That is mean Euro bond. Samurai bond, right? That is Tokyo, issued in Tokyo by non-Japanese, denominated in Japanese yen. And bulldog bond, it is denominated in bulldog pound sterling. That is my bulldog. Masala bond, right? It is a rupee bond. Rupee denominated bond issued by Indian corporation borrowed who invests in overseas market. Municipal bond for your infrastructure projects, etc. by the municipal corporations. Government or treasury bonds issued by the government of India. All right. All right. Then comes ratio analysis. Current ratio, current assets by current liabilities. Quick ratio. Now from this current assets, right? You have to remove your, so the thing is current assets is for 1 month, 1 year period. Clear all of you? 1 year period. In that cash and cash equivalents, say you can convert it within a 3 days time. Clear? 3 to 7 days, that is cash and cash equivalents. Then trade receivables, receivable, you can receive that trade receivable say in 3 months time, right? But inventory, right? First you have an inventory holding period, it has to get sold, after that it has to get converted to cash, receivables, and then receivables will get converted to cash. Clear all of you? So it's a longer process. Therefore current ratio will include everything: cash and cash equivalents, trade receivables, as well as inventories. Quick assets, you remove inventories. Clear all of you? That is called quick assets. And then when you remove trade receivables, you get cash ratio. Denominator in all the three is current liabilities, right? The ideal current ratio is 2:1. Ideal quick ratio is 1:1. Then basic difference interval ratio, quick assets divided by operating expenses, daily non-cash operating expenses. Clear? Daily non-cash operating expenses. So that, sorry, daily cash operating expense. That means you have to exclude the non-cash expenses. Is it clear, all of you? From this, you have to exclude cash, your non-cash expenses like depreciation, etc. has to be excluded. All right. So that is why it is written here. Business to meet regular cash expenditures. Il Bardilla, please make a note. Operating expenses means it is cash operating expenses. Clear? Net working capital, current assets by minus current liabilities. But here it excludes my short-term borrowings. The current liabilities exclude short-term borrowings. Equity ratio, shareholders' equity divided by capital employed. Clear? Shareholders' equity divided by capital employed is equity ratio. What is the difference between equity ratio and proprietary ratio? Here it is divided by total assets. Here it is divided by capital employed. Okay, that's the difference. Note down the difference, right? Debt ratio, total outside liabilities by total debt plus net worth. Debt plus net worth or net assets, right? Or in other words, it's also called capital employed. The same thing. Next. Debt to equity ratio, total outside liabilities by shareholders' equity. Debt to total assets ratio is total outside liabilities by total assets. And capital gearing ratio, that is fixed percentage bearing funds. Fixed percentage bearing funds. That means in this preference share capital also will be included. Preference share capital plus debentures plus other borrowed funds divided by your equity share capital, reserve and surplus minus losses. Is it clear all of you? That is nothing but your net worth. Clear? Yes. So these are your important ratios, capital structure ratios. Then comes coverage ratio. In coverage ratio, very simple, you have to understand what is being covered and what is covering it. What is being covered and what is covering it. For example, debt service coverage ratio. Here you are covering the debt service, right? So what is my debt service? My interest plus installments. Is it clear? Which is my EMIs. Interest plus installments, that is my EMIs. Understood? That is being covered. So whatever is being covered will be in the denominator. What is covering it will be in the numerator. So earnings available for debt service will be in the numerator, right? Now, what is the difference? So what I want you to do is first learn fixed charges coverage ratio. First learn fixed charges coverage ratio, that is EBIT plus depreciation. Clear all of you? Divided by interest plus repayment of loan. This should be number one. Next comes your interest coverage ratio. So EBIT divided by interest. Sorry, interest coverage ratio number one, fixed charges coverage ratio number two, number three is debt service coverage ratio. So interest coverage ratio is just EBIT divided by interest. Clear? What is being covered, right? And what is covering it? Interest is being covered. EBIT is covering it. Clear, all of you? Interest coverage ratio. Then comes, okay, interest, only interest is getting covered, but we want principal also. Therefore, fixed charges coverage ratio, right? So in EBIT plus depreciation, is it clear, all of you? EBIT plus depreciation will be in the numerator divided by interest plus repayment of loan. Next, here tax is actually an outflow. Therefore, post-tax EBIT plus depreciation divided by interest plus installments will be my debt service coverage ratio. So DSCR will be post-tax, fixed charges will be pre-tax. Is it clear? Right? All right, then preference dividend coverage ratio. What is being covered? Preference dividend, that will come in the denominator. What is covering? Obviously, the earnings which is available preference dividend holders, preference shareholders. That is nothing but earnings after taxes or profit after tax. Total asset turnover ratio. Now, all the asset turnover ratios and efficiency ratios, right? Turnover will be in the numerator. Do not go by the terminology. It's not total assets by turnover. Clear, all of you? Turnover will be in the numerator. Total assets in the denominator. So in all turnover ratios, sales or COGS is in the numerator, and then the name of the ratio will be the denominator. For example, total assets turnover ratio is turnover divided by total assets. Fixed asset turnover ratio, turnover divided by fixed assets. Is it clear? Right? These are all your turnover and efficiency ratios. Next comes your debtors turnover ratio. Here credit sales has to be used, and average accounts receivables. Under receivables or velocity period, that is average accounts receivable divided by daily credit sales. Payables turnover ratio, annual credit purchases divided by average accounts payable. Okay. Profitability ratios, gross profit ratio, net profit ratio, and operating profit ratio. Gross profit by sales, net profit by sales, and operating profit divided by sales. Expense ratios, COGS ratio, COGS by sales, operating expenses ratio. Very important. Operating expense, only administration and selling and distribution is covered. Clear, all of you? Operating profit is different. Operating expense is different. Operating ratio is different. Operating profit will include only my operating profit. Understood? You will not consider financial expenses here. In your operating expense, you are not considering COGS. Artha agta idea? In operating expense, COGS is not considered. Operating ratio means it is operating cost ratio, that is COGS plus operating expenses. Did you all make a note of these differences? Yes. Next comes financial expense ratio, financial expense by sales into 100. Then profitability ratios, you have your return on investment, that is the return divided by investments into 100. Return on assets, net profit after taxes. So there are different versions of return on assets. Clear, all of you? It can be profit before tax, it can be profit after tax, it can be EBIT into 1 minus T also. Understood? It can be EBIT by total assets also, right? Depending on the question, you can take any one of the interpretations. Now, return on capital employed, EBIT divided by capital employed into 100. DuPont analysis, it states that it is a factor of three things. Return on equity is a factor of three. First is my asset turnover ratio. Second is what? Sorry, first one is my net profit ratio. Second is my asset turnover ratio. Third is the equity multiplier. Clear, all of you? First is my net profit. Second is asset turnover ratio. Third is equity multiplier, that is total assets by sales. If you are considering capital employed, then accordingly in the numerator it will change. Right? If investment is considered, then again in the investment it will change. All right. Cost of capital. It is the return expected by the providers of capital, shareholders, debenture holders, etc. Right? It's also called cutoff rate or hurdle rate. Significance. It is used for evaluation of investment options, financing decisions, and also for taking capital budgeting decisions. KD formula, very simple. I into 1 minus T divided by net proceeds. Is it clear? This is for irredeemable debt. If it's a redeemable debt, then approximation method formula is I into 1 minus T plus RV minus NP by N, the whole divided by RV plus NP by 2. Able to remember, all of you? Sir, when should I use approximation? When I should use IRR? If the question is silent, you can go for approximation. If the question is silent, you can go for approximation. If there is a hint for IRR, then you go for IRR, which for in bond we call it as yield to maturity. In bonds we call it as YTM method. Is it clear, all of you? That is by using interpolation technique. Sir, how do I use interpolation technique? right? So you take lower rate and higher rate, understood? At lower rate you calculate what the NPV is, at higher rate you calculate what the NPV is, understood all of you? So if you remember, we want NPV to be 0 at IRR, correct? At IRR NPV is equal to 0 because present value of cash inflow will be equal to present value of cash outflow, yes or no? Therefore you will find out, okay, at a lower rate what is my NPV, at higher rate what the NPV is. Lower rate normally positive, higher rate normally negative, understood? Right? Positive and negative. So what will you do here? Next, once the NPV is found out, okay, we want NPV to be 0. However, at L it is positive, at H it is negative. Interpolation, that is cross multiplication. Clear all of you? There's nothing but cross multiplication, you will get the answer. Otherwise, formula you all have learned, lower rate plus NPVL divided by NPVL minus NPVH into H minus L. Clear all of you? So using that also you can find out what my KD is. Okay. Only thing here, cash flows, when you're considering, take the cash flows from the perspective of investor. You think you're an investor, you're investing, so cash outflow. You're getting income, so cash inflow. That way it'll be easy for you to calculate the YTM. Next, preference dividend, similar to debt, only thing is debt is tax deductible. There's tax advantage on debt. On preference dividend, there is no tax advantage on debt. Therefore, the formula is PD divided by NP. Okay. Then same formula here, only thing 1 minus T will not be there. For approximation method, PD plus RV minus NP by N the whole divided by RV plus NP by 2. KE, cost of equity, there are different approaches. First one, dividend approach. Sit straight all of you. Dividend approach. Here, the assumption is that the value of a share is nothing but present value of all the future dividends. The assumption is that this is also called dividend discount model. It's also called dividend discount model. Clear all of you? Under dividend discount model, the assumption is that the value of a share, Aditya, is nothing but present value of all future dividends. Is it clear? Right? Now, here obviously the assumption is that there is no growth, dividend is constant and it is forever. There is no growth, dividend is constant and it is forever, and that the dividend, earnings and shares, all of them are correlated, right? Therefore, the formula K is equal to D1 by P naught. Okay. Next, earnings price approach. Here, the assumption is that the earnings is constant and there is no growth. Earnings is constant and there is no growth. Clear? And that the expectation of the stakeholder is actually the earnings and not the is actually the earnings and not dividend. Is it clear all of you? Yes. Now, under earnings price approach, there is no growth. When we have also learned that when does a company not have growth? A company does not have growth when it does not retain any of its earnings and it distributes 100% of the dividends. Clear all of you? So that is the assumption under first option as well as second option, right? That is earnings price approach. Formula is EPS divided by P naught. Next comes Gordon's model, a dividend growth model. Under Gordon's model, a dividends growth model, formula is very simple. K is equals to D1 by P naught minus F. That is your net proceeds. P1 by D1 by P naught plus G. D1 by P naught plus G. Is it clear? K is equals to D1 by P naught plus G, where P naught is nothing but net proceeds. Net proceeds is you have to minus the flotation cost. Clear all of you? Yes. So this is the formula for Gordon's model, and formula to calculate G, that is B into R, retention rate into rate of return. That R is return on equity. Clear all of you? R is return on equity, right? So retention rate into return on equity, that is my growth rate. And using average method or using your present value factor method, dn is equals to d naught into 1 plus g to the power n. Clear? Yes. Right? CAPM approach, K is equals to RF plus beta into RM minus RF, where beta is the systematic risk only. Beta is my systematic risk, that is my non-diversifiable risk. Clear? All right. Then KR, KE is normally equal to KR. KE is normally equal to KR. There are just two differences. One is flotation cost is not considered in KR. Clear all of you? Flotation cost is not considered. Second one, issue price is not considered here. Here the market price is considered, right? Normally issue price you consider for KE, but for KR the market price is considered because you're not issuing any fresh equity shares. Weighted average cost of capital is nothing but the weighted average of all the cost of capital, that is cost of debt into proportion of debt, weight of debt. WD into KD plus WE into KE is nothing but weighted average cost of capital. Optimum cost of capital is that optimum capital is that combination which gives the minimum weighted average cost of capital, right? So here we understood when you're considering the market value of shares, right? The share price already incorporates reserves. Do not add reserves again. Second, book value of equity when SA, it includes the reserves also. Market value of loan is nothing but the book value in normal cases. Target weights refer to the optimal weights determined by the management. Weighted marginal cost of capital, the cost for raising the additional capital is called weighted marginal cost of capital. If the weights of the new capital as well as the cost of the new capital is same, then WMCC will be equal to WACC. Amortization of bond, when bond are being amortized, you need to take the cash flows and divide and discount it at KE. Is it clear, all of you? Yes. The realized yield approach, there is one thing I did not discuss under for calculating cost of equity KE. Clear, all of you? Realized yield approach. Here, normally past data is considered. Understood? Yes. So there will be capital appreciation of the share price as well as dividend. Both has to be considered to calculate what my realized KE as per realized yield approach is. Yes. So next one. So far we discussed about what is the cost of capital. Now the decision about capital structure. What should be the combination of the capital such that the value of the firm is highest? For the value of the firm to be highest, we know that the formula VF is equals to EBIT by KO. Therefore, KO should be the least. If KO is less, value of the firm is high. Is it clear, all of you? Therefore, optimum capital is that combination of capital where KO is the least. Where KO is the least. Clear? Capital structure theories, there are different theories in that there are relevance and irrelevance theories. Relevance means that they are stating that capital structure decisions are relevant. You are important. You are God, right? Whatever you decide is going to impact the valuation of the firm. Clear, all of you? Yes. So, what are the capital structure theories that are relevant theories, right? First one, net income approach we learned. Then traditional approach and then model with tax 1963. Clear, all of you? Next, these are your relevance theories. Then irrelevance theories, NOI approach, net operating income approach, Kirtana, and your model without tax 1958 model. I told you model more or less is the same as NOI approach. Only thing is he has proved it through operational justification through arbitrage process. Understood? So these are your relevance and irrelevance theories. Then you have your pecking order theory, right? And trade-off theory. Okay. Now formula V is equals to EBIT. Let me screenshot. V is equals to EBIT or NOI divided by KO. NI by KE or NI by S. NI by KE is S. And D is equals to V minus S or interest by KT. Clear, all of you? V is equals to S plus T. Next. NI approach, net income approach. This says that with the increase in the weight of debt, KO should decrease because KD is less than KE as long as KD and KE remain constant. Yes, as long as KD and KE are constant, KO should decrease with the increase in the weight of debt. Next, net operating income approach. Here, your KO and KD are constant. Okay, what it says is that with the increase in the weight of debt, because KD is less than KE, listen to me, all of you, rather than looking at the screen. Yes, with the increase in the weight of debt, because KD is less than KE, KO should come down. However, when you take more debt, equity shareholders are perceiving higher risk. For higher risk, they want more return. Therefore, KE starts increasing. Understood? Therefore, this reduction of KE is offset by the increase in K. This reduction in KO is offset by the increase in KE. Therefore, net effect will be zero, and hence they say that the value of the firm will be constant irrespective of your capital structure decision. Okay. Traditional approach, up to a certain level, debt is good. Up to a certain level, both KD and KE will come down. However, beyond a certain level, both KD and KE will increase. So, model without tax, 1958. Arbitrage process is the process wherein two similar products traded in two different markets. Clear, all of you? Right? Trade in two different markets should ideally be of the same price. Be of the same price. However, for a short span, there is a possibility of arbitrage gain or loss. There's a possibility of arbitrage gain or loss. What is this arbitrage gain or loss? Wherein you buy an undervalued company and you sell an overvalued company. Clear, all of you? You buy. So if there are two companies, the actual value of both the companies is same. Understood, all of you? The actual value of both the companies is same. So in that case, what will you do? If there is one company which is undervalued, you sell that. Right? Sorry, you buy that and you will sell the overvalued company. Clear? You sell what is overvalued and you buy what is undervalued, and therefore you will be able to make an arbitrage gain there. Understood? Right? So here, this is a summary of the entire model. When you're moving from a levered firm to an unlevered firm, levered means it has debt, unlevered means it does not have debt. If you move from levered to unlevered, it means that levered company is overvalued and unlevered company is undervalued. Clear, all of you? Therefore you sell 10% of the equity of levered company. However, levered company has debt, right? Therefore you take a personal debt to the extent of 10% of the value of the debt of the levered company. I repeat, therefore you take debt to the extent of 10% of the value of debt of the levered company. Understood, all of you? Yes. So that is taken, and after that, this entire amount you can invest in the unlevered form. You can invest in the unlevered form if you are going for increase in income approach. In such case, you will not have any capital appreciation. However, year on year, the income that you receive will be more. Is it clear, all of you? Next, savings and investment approach. In this, what we do, we sell 10% equity of the levered company. We borrow 10% of the total debt of the levered company. However, you invest only 10% of the equity of unlevered company. Clear? In the previous one, you are investing the entire thing. In this case, you are investing only 10% of the equity of the levered company. Clear? Next, levered to levered. Unlevered to levered means unlevered firm is is you're selling it, and levered company you're buying. Unlevered firm here in this case will be overvalued, levered firm will be undervalued. 10% of the equity of the levered firm you sell, you invest that entire amount in both equity as well as debt, in the debt equity ratio of the levered firm. Okay? It is called increase in income approach. If you want to go for savings and investment, then you will not invest the entire amount. You will only invest 10% of the equity plus debt of the levered firm. Right? The balance would be your arbitrage gain. Model with tax. Again, model says that as long as two businesses are of the same risk class, belong to the same risk class, and have the same EBIT income, same risk class and same income, the value of the two companies should be same. Is it clear, all of you? The value of both the companies should be same. That is model without tax. However, with tax, you say that, oh, okay, now because there is tax, what will happen? VL, the value of the levered company should be more than the value of the unlevered company. Understood, all of you? He says, if tax is not done, both are equal. That means the only differentiating factor is tax now, right? Therefore, he says the value of the levered firm would be nothing but, right, after minusing all your, you know, uh, cash flows, everything, right? Value of the levered firm will be equal to value of the unlevered firm, considering, right, there is no debt. However, if debt is considered, then only the tax advantage on the debt should be added as the value of the firm. Therefore, VL will be equal to VU plus GT. Right? All right. Then, as per trade-off theory, VL will be equal to VU plus tax advantage on debt, however minus cost of financial distress. Right? Pecking order theory is not mentioned here. Pecking order theory is based on information asymmetry, right? It means that if a company uses retained earnings, you're not sending any signal to the outside market. However, if you use debt for a particular project, it sends a positive signals because you have high confidence that this project will earn an ROI which is greater than interest. Is it clear? If you go for equity, according to pecking order theory, you are showing negative signal. Okay. Designing optimum capital structure, ROI ROE relationship, where return on equity is nothing but ROI plus ROI minus I into debt by equity into 1 minus T. Clear? Indifference point, it is that level of EBIT at which the EPS and the two given alternatives is same. Indifference point. Right? Next, financial break-even point, it is that level of EBIT at which EPS equal to 0. Right? So interest, please correct this. All of you please correct. Interest as it is plus preference dividend divided by 1 minus T. So 1 minus T is only for preference dividend. Please correct this. 1 minus T is only for preference dividend. Then EBIT EPS relationship, that is P naught is nothing but price earning ratio into EPS. Basically, a price earning ratio tells you how many times the market price is compared to its earnings. Right? Financial leverages, sorry, financing distance, that is leverages. Here, it is the influence or power of one financial variable over the other. Understood? Influence or power of one financial variable over the other. How do you express it? Now, say there is a change in X and you're understanding what is the impact this change in X has and why. I repeat, there is a change in X. You are understanding what is the impact this change in X has on Y. This will be termed as what? It is termed as your leverage of y with x. It is termed as leverage of y with x. Clear all of you? Say for example, sales is increasing by 10%. What is the impact it has on EPS? What will you call this as? This is the leverage of your EPS on sales. Leverage of EPS on sales. Clear all of you? Simple formula, Pana get gray. Percentage change in y divided by percentage change in x. Percentage change in y divided by percentage change in x is my leverage formula. Clear? Right? Next, there are different risks an organization takes: operating risk and financial risk. Operating risk is measured by operating leverage, financial risk is measured by financial leverage. Clear all of you? Your margin costing until EBIT, that entire part is operating profit. That entire part is operating profit, operating risk. Understood? Right? Below that, that is less interest, and then you get earnings before tax, less tax, profit after tax, less preferred dividend, and then finally your earnings available to equity shareholders. Is it clear? Right? So yes, your formula for operating leverage measures the operating risk. Operating risk is nothing but your fixed cost. Is nothing but a fixed cost. Therefore, one above fixed cost, one below fixed cost is the formula for what? For your operating leverage. One above fixed cost is what? Contribution. Yes. Minus fixed cost is you get your profit. That is your profit before tax. Clear all of you? Yes. So contribution divided by EBIT is nothing but operating leverage. Then financial leverage is nothing but your financial risk. Correct, Likita? Financial risk is the interest cost. All of you clear? Financial risk is nothing but the interest cost. Therefore, one above interest, one below interest. What is one above interest? EBIT. One below interest is EBT. EBIT by EBT is nothing but your financial leverage. Combined leverage, right? Combined leverage is nothing but contribution divided by EBT. Contribution by EBT, or percentage change in EPS divided by percentage change in sales. Percentage change in EPS divided by percentage change in sales. Operating leverage, percentage change in EBIT divided by percentage change in sales. Financial leverage, percentage change in EBIT divided by percentage change in EPS divided by percentage change in EBIT. Clear all of you? Yes. Right. So all this we discussed. Yes. Margin of safety is sales minus break-even sales, right? So from that derivation we get what? Contribution minus fixed cost is profit. Profit by contribution is nothing but, so EBIT by contribution, right, is my margin of safety percentage. Is my margin of safety percentage. So this is nothing but 1 divided by degree of operating leverage. Understood? 1 divided by degree of operating leverage gives you my margin of safety ratio. Next, DOL, the degree of operating leverage can never be between 0 and 1. It can never be between 0 and 1. It can be 1 or more. Financial leverage, we already discussed all of this. Yes, this is a frequently asked examination question. Double S word, all of you concentrate now. When cost of fixed, when ROI, When ROI is greater than I, then debt is preferred. When ROI is less than I, then equity is preferred. Understood? Right? Therefore, when ROI is greater than I, you're going for debt such that ROE is more and EPS is more. Clear all of you? Right? And then vice versa. This is nothing but your financial leverage is a double-edged sword. Sir, why is that? Why is it a double-edged sword? Because if it is increasing, it will increase the EPS. But however, if it decreases, it will double decrease the EPS also. At the same drastic level, it will decrease. Therefore, it's called a double-edged sword. Understood? Yes. Combined leverage, I told you, right? Contribution by EBT or degree of operating leverage into degree of financial leverage. Management of working capital. So it's straight now, right? Working capital is nothing but current assets minus current liabilities. Different types of working capital you have based on value, based on time. Based on value, gross working capital, net working capital. Based on time, you have permanent and temporary. Remember my bakery example, right? So certain stock is always kept. Sweets example, right? Sweets though, bakery shop though, certain stock is always kept. Clear all of you? Someone is getting married, someone's exam got cleared, all that is happening throughout the year. Understood? However, during Diwali, right, there is high levels of stock kept. Understood all of you? That seasonal fluctuation will come in temporary. However, permanent stock is what is kept throughout the year. Understood? That comes, that is based on time. Based on time. Yes. Next comes your approaches for working capital investment. Sit straight. You have aggressive, conservative, and moderate. Aggressive approach. That means you're very aggressive. You want profitability to be high. Understood? You want the profitability to be high. Therefore, you will keep low current assets, low investments such that the interest cost, etc., obsolescence and all is less. Is it clear, all of you? Right? Such that your profitability is high. However, it is aggressive in nature. Why? Because if there is a sudden demand, etc., your entire production process can be hampered. Is it clear, all of you? Then conservative, right? You have high current assets. You have good investment because you don't want at any cost anything to be hampered. Understood? So therefore, that is called conservative approach. Next comes moderate. That is a mix of my aggressive as well as conservative. Clear, all of you? Right? Next, finances. When it comes to finance, you have aggressive and you have your conservative and moderate. Aggressive, you want high profit. Aggressive, you want high profit. Clear, all of you? Therefore, to have high profit, I told you this, that if it's a short term, how is the interest determined? If it's long term, how the interest is determined? Clear, all of you? Short term andre, all of us it straight. Short term capital, right? You are going to repay the debt sooner. Therefore, risk is lesser. If risk is lesser, interest is lesser. Long term, it's going to take more time for you to pay, right? Risk is more for the bank, so high interest cost. Is it clear, all of you? High interest cost, right? So if you're aggressive, you'll go for more short term debts. If you're conservative, you will go for more long term debts. Clear? Moderate is a combination of both. Then operating cycle, that is the time taken for the entire cycle, right from your raw materials till the same is realized into cash. That is the entire, that is my working capital cycle. So working capital cycle is R plus W plus F plus D minus C, where C is my creditors holding period. Right? R is raw material holding period, WIP holding period, finished goods holding period, plus trade receivables, right? Number of days, and then and then subtract creditors holding period. Yes. So raw materials, please understand. So for estimation of current assets or my estimation of working capital problems, we consider your cost sheet approach. Nanpitya, you consider cost sheet approach. Sir, working capital huge chapter, sir. Shall I keep solving only this? Right? No. Take one or two problems of estimation of working capital. Just go through the important adjustments. Understood, all of you? Don't solve. There are many problems in this area. Adanna kutkon madake likita. Now is not the time. Understood, everybody? Yes, now is not the time, right? So go through important problems and then go to the important adjustments. All the important adjustments you go through. Solve one or two problems to get the flow of these kind of questions. All right. Here, estimated production units is considered for raw materials, for WIP also, but you have to consider the percentage completion. Okay. Then funds to be invested, etc. All right. Under receivables, you have to consider credit sales units. Okay. Here, credit purchase is considered for trade payables, direct wages, and overheads. This is all fine. Here, safety margin has to be added before you consider the net working capital. This is equal to my EOQ model, Bowman's model, wherein two here annual demand only input is the annual demand of cash is considered here. Understood all of you? There it was setup cost or ordering cost per order or setup cost per run NPDA in EOQ model. Here, what is the cost per transaction? Right? For each transaction, what is the cost that will come here and divided by my carrying cost. That's the same here also carrying cost, interest cost, whatever is it, that has to be considered. Miller Rowe model, two levels will be set, upper limit and lower limit. When it reaches the upper limit, you will sell your investment, come back to the return point. When it reaches the lower limit, you will you invest. Sorry, when you reach the upper limit, you'll invest and you'll come down to the return point. When you reach the lower limit, you'll sell and you'll come back to the return point. Understood all of you? That is my Miller Rowe cash model. Right? So this is a simple formula for calculating the cost of payables. Please remember, creditors, nothing is free of cost in this world, right? There is a cost employed here. You're giving up your cash discount. That is the implied cost there. Okay. Factoring, recourse and non-recourse, right? That means that if bad debts are borne by the factor, right? That is non-recourse. If it is coming back to you, that becomes recourse. Understood? So maximum permissible bank finance, there are three categories. First one is 75% of current assets minus current liabilities, 75% of current assets minus current liabilities, 75% of current assets minus core current assets. Right? You subtract core current assets and then minus current liabilities. That becomes, those are my maximum permissible bank finances. Then comes your investment decisions. Here, right, first one is you have to select which project. Clear all of you? Which project and you have to select. Ali, most important, the project should be in line with your objective. Understood? The project should be in line with your objective. Only then you will select that project. Yes. So there are different capital budgeting techniques here for evaluating the decision. First one is NPV, net present value, where present value of cash inflow minus present value of cash outflow. Clear all of you? Then comes profitability index. That is present value of cash inflow divided by what? The present value of cash outflow. Next comes your net profitability index. That is NPV in the numerator divided by present value of cash outflow. Clear? These are the first three techniques that we learned. After that comes IRR, right? IRR basically gives you the internal rate of return. So basically to understand, sir, what is the return percentage? NPV is not profit. NPV is wealth creation. Correct? NPV is wealth creation. Sir, if I have to understand in terms of profitability, in terms of my return percentage, I calculate IRR. The method we have already discussed at the start of the session. Clear all of you? The assumption under IRR is that the intermediate cash flows are also reinvested at IRR itself, which is an aggressive assumption, and therefore you have modified internal rate of return. In modified internal rate of return, the assumption is that the intermediate cash flows are reinvested at a reasonable rate. Right? Here it is considered like it is reinvested at your cost of capital. Understood? If nothing is given, it is assumed to be reinvested at cost of capital. Take all the cash flows to the terminal year and then discount it at MIRR. Clear all of you? And then discount it at MIRR. That is my modified internal rate of return. Then comes your payback period. The number of years in which the investment would be recouped. That is my payback period. Here, time value of money is not considered. Accounting rate of return gives your base using your accounting profit. That is depreciation is also considered here. Understood all of you? That is called accounting rate of return. Right? Then comes discounted payback period. In discounted payback period, same payback period formula, but you'll take your discounted cash flows. Understood all of you? Yes. Next, considering your cash flows, very important. All of you concentrate. There are three categories of cash flows. First is your initial investment, right? Initial investment and starting cash flows. This could be fixed assets, working capital, right? In case of say a replacement of a machinery, it will be the incremental cash flows. Understood all of you? Then comes your intermediate cash flows, the year on year EBIT, right? Plus depreciation, then minus tax. Is it clear? EBIT into 1 minus T plus depreciation, CFAT. EBIT into 1 minus T plus depreciation. Clear all of you? Right? So exclusion of finance cost principle, remember, we don't consider interest here, right? Because KO already has interest component in it. is already considered in KO. Understood? Therefore, interest cost is not considered here. Minus tax, add back depreciation, CFAT is considered in your intermediate cash flows. Please remember, any working capital change in between the year also you consider it as part of Roman number one itself, right? X, Y, and Z, if you remember, right? The last one, terminal cash flows. There are two terminal cash flows which is possible. One is your release of working capital. If the question is silent, you're assuming that the entire working capital is released at the end of the project. Clear, all of you? Which is considered as a cash inflow at the end of the project. Next is your scrap sale, the fixed assets which is sold at scrap, that is also considered as cash inflow. Clear, all of you? So take these cash flows and then apply the present value factor and find out what the NPV is. Is it clear? Right? So these are the important discussions in your capital budgeting. Ali, very important. This depreciation calculation should always be based on depreciation tax rate and not their accounting tax rate. And you will consider the depreciation methodology of considering that your block concept is considered here. Understood? Block concepts has to be considered. Yes. So the last chapter, dividend decisions, right? So the same concepts here also very similar to your capital structure chapter. Here also you have relevance theory and irrelevance theory. Under relevance, you have Walter's model and Gordon's model. Again, extremely important, repeatedly asked examination questions here. Model, normally proving concept will be asked here. Walter's model formula, D plus R by KE into E minus D, the whole divided by KE. Yes, very simple. Same thing here also. If the rate of the project is more than KE, then you don't give out anything, don't pay out anything. Clear, all of you? Because you want 100% growth, you can retain everything. However, if the return of the project is less than is equal to KE, then it is indifferent. If it is less than KE, then 100% dividend payout. Same thing under Gordon's model also. Gordon's model formula we have already learnt in your capital structure chapter. But the same thing, earnings into 1 minus retention rate, E into 1 minus B. We is the 1 minus B is your dividend payout. So this is nothing but D1. D1 by KE minus BRSG. D1 by KE minus G is nothing but PO. That is my Gordon's model. Modi, Glani and Miller approach in that P0 is equal to P1 plus D1 by 1 plus KE, right? N P0 is equals to, we learned as M, if you remember, P1 plus so P1 into N plus change in N, that is the additional shares issued, that is M. Clear? N plus M minus I plus E whole divided by 1 plus KE, right? All right. And the number of shares is nothing but investment minus your earnings minus retention, right? Earnings minus dividend payout, that is your retained earnings. Investment minus retained earnings divided by P1 will give you number of shares. Graham and Dodd model. Remember, a bird in hand is better than two in the bush. Therefore, dividend is given more weightage than earnings. So D plus E by 3 into multiplier. Right? Lintner's model, to ensure that there is not lot of fluctuations in the dividend. That is why D1 is equal to D0 into EPS into target payout ratio minus D0 into adjustment factor. Yes. Okay. Suggested answers, if you see here, the analysis is given here. So not lot of pattern is there, but however, little bit pattern you can identify here. Okay. So ratio analysis problem was asked in the first this thing. So if you see here, question number 1 only, ratio analysis has come 2 to 3 times, right? Then if you see your leverages has come here. I told you one question on leverage will always come. Dividend discount model will always come. Here different type of leverages. If you see here, again here problem on leverages. Can't say the right? Again here dividend. So your dividend discount, all of it normally comes in your first question itself, right? Then your second question, cost of capital, cost of capital, cost of capital. Are you able to see this? Yes. Then 2A leverages. Then here very important. Look at this dividend distance here. Right? In your first two questions itself, leverages and dividend distance gets covered. Then comes your working capital question. Illu ide. Okay. Then theory question is there. Capital structure, investment distance. Idli kuda. This one you can see here. Investment distance here. Investment decision problem here. Here also this is investment decision problem. Okay. All right. Then here, if you see this capital structure. All right. And then your theory questions. Theory na skip ಮಾಡಬೇಡಿ. Okay na? Yeah, you know the question paper pattern. MCQ 15 marks. Yes. Descriptive will be 35 out of 47. And then here strategic management 15 marks and then 35 out of 50 marks. Ali, very important. Question number 1 is compulsory. So ಅದನ್ನ skip ಮಾಡೋಕ್ಕಾಗೋದಿಲ್ಲ ನಿಮಗೆ. I hope you know that. MCQs you cannot skip, right? There is no negative marks. So ensure that you have attempted all the MCQ marks. Clear all of you? I'll just quickly go through the order of the selection of questions. Yeah. One second. Yeah. Look at this. Right, so this is the preferred order and it has worked. Many of them have followed it and it has worked. So 2 to 210, scribble in the last page important points of some of the questions. First 15 minutes obviously spend time on selecting which question to attempt, which one not to, right? So then 210 to 240, first question selected, best and well-known question, right? 240 to 3, second question, and then 3 to 315, last question selected. Okay, both FM and SMMCQ 315 to 355. Now, very important is your SMMCQ. SMMCQ ಅಲ್ಲಿ please read it. So now only I'll cover the question paper pattern. Ali SM ಅಲ್ಲಿ please ensure that you're reading the question case studies carefully. Understood all of you? So normally one case study will come, right, of 10 marks, the first one, and then you will have your 2 and 1 mark. Clear all of you? Ali first case study na, read it 2 times, right? Read the questions carefully. It will normally sometimes will be easy, sometimes tricky irutte. Be careful. Clear? If it is easy, then go ahead and do it. But after read the questions, go back and read the case once again and do it. But spend some time on it. Don't waste time. Spend some time, some quality time, so that you can score 10 on 10 in the case study of the SM. It's possible, easily doable. Clear all of you? Don't rush through the case study. Clear? Right? Next question 2, 3, and 4. Choose what you're comfortable with to start with. Choose what you're comfortable with to start with. Otherly SM only, please understand, there'll be some direct questions, there'll be some case scenario questions. If you're comfortable with case scenario, choose such questions. If you are not, then go with the direct. Understood? Ali, case scenario sir would have very clearly told, go for concept, then fact analysis and conclusion. Adana clearly follow Madi for all case scenario problems. Direct question idru, give examples. Understood all of you? Right? Prepare well. In FM also, your case scenarios is easy. Right? Spend quality time there. ಅದನ್ನ ಮಧ್ಯದಲ್ಲಿ MCQ time ಅಲ್ಲಿ ಮಾಡಿ. ಅರ್ಥ ಆಯ್ತಾ? So ensure that question 1 of your FM, question 1 of your SM and MCQ you plan properly and do. Clear all of you, so that you don't miss it at any cost. Please attempt the FM theory so that you can score and complete your paper. That is most important thing. Understood all of you? Rejection is the most important thing, right? So anyway, if I'm telling you, if you're good with theory, anyway question 4 you'll attempt, then you're left with only 2 questions to reject. Artha aita? Yes. All right. SM only 5 chapters, introduction chapter, right? In that you have, I think, some important topics like strategy versus strategic management, then strategic intent, right? If you go through the question paper pattern also of SM, strategic intent is asked. Then memorize some 3 to 4 vision and mission statements by heart it, so that you can uniformly use for everything. Clear all of you? Right? Vision and mission statements now, what you can follow for uniformly with any given case, you should be able to apply that. Adin use ಮಾಡಿ. ಅರ್ಥ ಆಯ್ತಾ? Clear all of you? Then 3 levels of strategy, what you learned: corporate, business, and functional, along with the roles and responsibilities. Clear all of you? Along with the roles and responsibilities, sir would have always stressed on that. Then mission, what you're doing. Then vision, where you're going to be. Adanna, like I said, 3 to 4 companies to bat ಮಾಡ್ಬಿಟ್ಟು, so that you can apply it uniformly for all things. Then comes your second chapter, right? ಅದರಲ್ಲಿ ಬಿಫೋರ್ ದಟ್ ಫಸ್ಟ್ ಚಾಪ್ಟರ್ ಅಡ್ವಾಂಟೇಜ್ ಅಂಡ್ ಲಿಮಿಟೇಷನ್ ಸ್ಟ್ರಾಟಜಿಕ್ ಮ್ಯಾನೇಜ್ಮೆಂಟ್ ಅದೊಂದಿದೆ, ಅದನ್ನು ನೋಡ್ಕೊಂಬಿಡಿ. ಕ್ಲಿಯರಾ? ನೆಕ್ಸ್ಟ್ ಇಯರ್ external analysis. In external analysis, your business environment, a business environment allu micro, you have your internal external business environment. In external business environment, you have micro and macro. Clear? Micro andre in your vicinity, whatever is there, one chemist shop is there, a pakkad chemist shop, that becomes the micro, right? But for the same chemist shop, a big pharma would be macro. Understood? Right? I hope you're able to recall. So adanna go through ಮಾಡಿ. Then other aspects what you have learned in your second chapter, value chain analysis, then product life cycle, then Michael Porter's though 5 Porter analysis. So other, all these are important things. Three strategies, Michael Porter's three strategies, right? And then product analysis, this is your second chapter. So right, so first chapter, then your second chapter. Thirdly, okay, before I forget, one important thing is, in the recent trend, what you've seen in the previous paper, question paper, do normally it is not getting repeated. Previous question paper, in the next question paper, it is normally not getting repeated. Angant, I'm not telling you to skip, but I'm telling you to keep that less priority. Okay. Then strategic choices. Strategic choices is your fourth chapter. Otherly, all matrix you have, no, all different BCG matrix, ugly ADC matrix, all the matrices are important, right? Fifth chapter is voluminous chapter, right? Right. So you study that accordingly. It is important. I'm not saying no, but anganta fifth chapter ಮಾಡ್ಬಿಟ್ಟು, it's like a combination of two chapters. Fifth chapter, right? It is an important chapter. It is definitely, you cannot skip that chapter for whatever reason. But anganta, do not lose focus on the other chapters. I repeat. So I to conclude with, I will conclude with the analysis of SM, because FM analysis we saw, SM analysis we'll see. But before that, what I want to say is, off late, I want to repeat this, off late people are not focusing on SM. Don't do that. You have a golden opportunity time there. If you have some weaknesses, make sure that you're revising the SM concepts on a daily basis. Give equal importance to FM and SM. There is no point of scoring 45 out of 50 or 50 on 50 in FM and not scoring anything in SM, right? Clear, all of you? So pay equal focus on SM. Also, let's quickly just go through SM do adu paper analysis. Although I was not able to find a lot of trend here. Yes. Tumba and trend, I was not able to see. So theory papers, what I'm observing is, there are not a lot of trend. Even audit, I went and checked once. Theory, I'm not, but practical, definitely there is some trend in all the practical papers. So FM only I've shown you. Illy, not much trend, but anyway, at least you know what the repeated concepts are. So it may not be, so Porter's 5 posters you can see here. Mission statement bagay, I was just saying. Strategic intent, I told you, first chapter is important. Organization structure, retrenchment strategy, right? BCG matrix here, there, all the matrices are important, right? So differentiation strategy, success factor, so all of this you can go through once, right? This thing, so you know at least, right, how the questions, from which area the questions are coming. Anganta, there are so many topics. Definitely there will be one topic that has not come in the last 5 papers. Couple of topics will not come. So in this cannot be a basis for preparation. Don't keep that as a base. This is only for understanding, okay, what are my important topics that is frequently coming on the artha aita. Doesn't mean that you can skip the others. You need to pay equal focus on the others also, right? All right. Thank you, everybody. Bye, all of you. All the best and rock the exams.
Thank you,
Yes,
sir.